Hello everyone, my name is Fred, and I'm your host in this segment where I featured key personalities in the field of investments, stocks, and cryptocurrency. If you're new to our channel, subscribe now because we upload videos that can help in your wealth building. Today, we are going to talk about the predictions or beliefs of Charlie Munger about the stock market, which he believes will happen for decades. So, let's get started. Charlie Munger, who is Warren Buffett's right-hand man, is renowned as a legendary investor. Since 1986, he has outperformed the market through the daily journal portfolio by almost 2,000%. Munger recently discussed the important issues in the economy and financial markets at the Daily Journal's annual conference. In this video, Munger discusses how his portfolio is being set up to significantly outperform the market in the ensuing years. We must examine the macroeconomic environment to comprehend how Munger intends to profit significantly from the economy. Due to COVID-19, consumer spending abruptly stopped, necessitating intervention from the federal government to provide support. Unemployment can be classified into two categories. All unemployed people who are looking for work are tracked by U3 unemployment. A broader definition of unemployment, known as U6, also includes discouraged workers and part-time employees. U3 unemployment exceeded 14% in April 2020, while U6 unemployment exceeded 22%. 4 people were either unemployed or underemployed for a significant amount of time. As a result, Congress gave grants and various lending options to state and local governments, as well as stimulus checks to the general public. Additionally, the COVID relief funds provided by these checks benefited businesses. The Federal Reserve decreased interest rates, which reduced the cost of borrowing on the monetary front. At the end of February 2020, the target interest rate was approximately 1.5%. By April 2020, it was approximately 0.06%. Everyone anticipates that rate, which is currently 0.08%, to rise. These policies are preparing the ground for a terrifying economic crisis, as we'll discuss shortly. The Federal Reserve increased its market-based purchases of treasury bonds, or quantitative easing, even as interest rates were decreased. The Federal Reserve bought more than $4 trillion worth of debt during the pandemic, which had the effect of pumping money into the economy. Cash on hand, savings, money market, and certificates of deposits under $100,000 are all measured using the M2 metric. Inflation eventually became governed by the law of supply and demand. The demand for goods increased as more money became available to everyone, but this did not cause the inflation we are currently experiencing. Munger is acutely aware of the effects of an asset bubble, inflation, and the rise in M2 money. The situation has also continued to get worse as a result of the supply chain issues. You have probably noticed that there are fewer items available in stores and that some items, like consumer electronics, are becoming more expensive. The main cause of this is the inability to transport goods from boats to markets. The fundamental problems existed before COVID, but the pandemic accelerated their development. The underlying problems are numerous. The capacity to offload ships is constrained, and there aren't enough chassis to increase it. Because there haven't been any wage increases, fewer truckers are now permitted to work at the ports. The problem was also made worse by U.S. warehouse technology, which is less advanced than that of Japan, Korea, and China. Similar to this, the pay for warehouse workers hasn't always kept up, and it's harder to find good warehouse workers. Supply chains have been made even more limited by the labor shortage in warehouses. An experienced truck driver named Ryan Johnson explained some of the problems in a post that quickly gained popularity. He compares the current supply problems to having one cashier for hundreds of customers at a store like Costco or Walmart. For hours on end, truckers like him must wait in 3 different lines before being able to pick up a container to transport goods across the nation. The supply chain is tracked by Goldman Sachs and a few other investment companies, with 10 being the highest stress. Goldman recently reduced the stress to a 9 out of 10. The number of ships at the Los Angeles port waiting to unload cargo has decreased to 89 from a high of over 100, according to the Marine Exchange of Southern California and Goldman Sachs. When you consider there were no vessels 20 months ago, that is a sizable amount. Even though it might sound terrifying, there might be hope. While there are many different predictions for when this economic crisis will be solved, it appears to be closer to the end of 2022 or the middle of 2023. The important thing to remember is that virtually all of this pressure leads to a shortage of goods. Consumer prices have reached new highs as a result of this pressure and the expansion of the money supply. The Consumer Price Index recently picked up the speed, rising 7.5% annually. Understanding the connection between inflation and interest rates is crucial in this situation. To beat inflation during the 1980s, Fed Chairman Paul Volcker repeatedly increased interest rates. Although the outcome was positive for the economy as a whole, raising rates is typically not a politically popular move. Even though the Fed is supposed to be above politics, Charlie Munger said it was unlikely that someone like Paul Volcker would be able to raise rates in the current political climate. In addition, he warned that these issues might develop and become worse than those of the late 1970s and early 1980s. It was not a good time to invest in the market in the late 1970s and early 1980s. When adjusted for inflation, the market returned 0% from 1965 to 1980. Munger issues a similar caution, stating that the market may experience negative returns over the next 10 years. Well, nothing quite like what we're doing now has ever existed. We also know what has occurred in other countries. It eventually leads to terrible trouble if you try to print too much money. Furthermore, although it may still be a long way off, we are now closer than ever to experiencing terrible trouble. I sincerely hope it is. The first decade of high inflation and low stock market returns adjusted for inflation was the first outcome we discussed. Munger might be even more alarmed by a second possibility than the first. The Fed has already announced that it will be raising interest rates because it does not want a repeat of the 1970s to occur. The largest futures exchange in the world, CME Group, recently released a report that examines the market and the reliability of investor rate hike predictions. Right now, forecasts call for 4 to 6 Fed rate increases in 2022 and another 2 to 3 in 2023. These increases typically happen at a 25 basis point rate. 1 basis point is 0.01%. Therefore, a 25 basis point increase would represent a 0.25% increase. The rate would therefore increase by 25 basis points to 2.25% from 2%. Rather than the current 0.08%, the target interest rate is anticipated to reach 1.625% in the end. The Federal Reserve is also decreasing its purchases of assets, particularly Treasury bonds, also referred to as Treasury bills. A similar action reduces the amount of money that is readily available. The Federal Reserve cut purchases in January 2022 by $60 billion, a decrease of $30 billion from December and $60 billion from November. The Fed is still buying bonds, which raises the supply and artificially increases demand for treasuries. As the Fed reduces its purchases to a crucial price and yield level, an equivalent amount of new demand would need to enter the market. The lack of Fed bond purchases would need to be offset by this new demand. The Treasury would need to find outside investors willing to increase their portfolios by $60 to $100 billion per month to have a net zero impact on the market. That is highly improbable. As a result, bond prices will decline as a result of the tapering. Since bond yields and prices are inversely correlated, higher U.S. Treasury yields would result. The tapering of bonds will therefore have a significant impact on bond yields and consequently interest rates, even though the media focuses on the Fed raising interest rates. Charlie Munger is hesitant to claim that the rise in rates will cause the low-rate asset bubble to burst. He thinks the lower rates were implemented as a drastic measure when the COVID pandemic first started. The US is flirting with trouble that will end badly the longer we stay with low rates and high inflation, especially now that we are past COVID and need to live with it. According to conventional economic theory, the past 2 years have been too much monetary and fiscal stimulus, which has led to the highest inflation in 40 years. Do you generally concur with this claim? And more importantly, do you think there will be a high economic price to pay as the Fed attempts to bring inflation back under control? Well, I concur with the first part, although we have taken action. It has been fairly extreme and we are unsure of the extent of the problems. Life is interesting because we have no idea how things will turn out, whether we'll end up like Japan or much worse. I believe you are aware that we are teetering on dangerous territory. I believe you also realize that some of our initial worries were exaggerated. What should investors do now that we are aware of the dire state of the economy? Munger is pessimistic about office space as commercial real estate, but he advises investing in apartment building stocks. The Mungers own shares of Berkshire, Costco, Chinese stocks through Lilu, a small amount of daily journal stock, as well as a large number of apartment buildings. Do I believe that is ideal? No. Do I think it's okay? Absolutely. I believe the most important lesson we can learn from the Mungers is that you don't need all this damn diversification. That's more than enough. You're lucky if you have 4 high-quality assets. Munger contends that diversification beyond 4 to 6 investments is not a good idea, which is the opposite of the majority of investment professional advice offered in business classes. He makes the case that too much diversification has diminishing returns, though he does not provide a specific figure. Markowitz's Modern Portfolio Theory, or MMT in short, provides a solid foundation for his claim. According to this theory, adding a stock lessens the portfolio's swings, and the swings get smaller and smaller as you add more stocks. The portfolio's impact is decreasing with each additional investment, so historically this trade-off is not one-to-one. Naturally, this is based on the supposition that each investment is proportionately equal to the others. Each stock would represent 10% of the portfolio if there were 10 stocks. Each stock would be 20% in a portfolio of 5 and 1% in a portfolio of 100. As you might anticipate, one stock doubling would have little effect with 100 stocks, but with 5 stocks, one stock doubling would have a significant impact. According to Munger, the current market is ideal for speculation and gambling. He used the SPAC sector as an illustration which raises money before receiving investments. Of course, GameStop's great short squeeze was a miserable excess. Undoubtedly, the Bitcoin phenomenon is an abhorrent excess. I would contend that venture capital is dispersing money too quickly and that there is a serious excess of both venture capital and other types of private equity. We therefore have a stock market, which some people use as a gambling den, and the transactions of those who enjoy the casino-like aspect of the industry as well as those who want to make long-term investments to provide for their future, among other things. If you model that in just one market, it quickly spirals out of control because trading stocks is the perfect activity for a casino. In my opinion, that shouldn't have been permitted either. Along with the 850 SPACs, Munger also mentions the great short squeeze and high multiple valuations as indicators. Based on Bloomberg estimates consensus earnings, the S&P 500 is currently trading at a 20 times forward PE. Such frothiness has not been observed in 20 years, even though this is down from the most recent peak of 27 times in August 2021. Similar to the Nasdaq, which has decreased from its recent December peak of 40 times to a PE ratio of 28 times according to the Bloomberg consensus. Since 2003, these levels have not been observed. Given the current macroeconomic environment, diversification outside of the US might be advantageous. Through stocks like BYD and Alibaba, Munger has made investments in China. Munger's investment in Alibaba more recently was prompted by one of his best decisions of all time, BYD. He explained why he decided to invest in China despite the significant risks in both this year's interviews and those from last year. Due to the recent news, I'm sure many of you are aware that investing in China carries several inherent risks. Charlie Munger, however, thinks that while these risks such as regulatory, economic, and delisting concerns do exist, the value in China's financial market is significantly higher than in the US. So, we did it for a very straightforward reason. Per dollar invested, we gained more strength. The Chinese businesses we invest in are more robust than their rivals and offer more affordable prices. We are in China for that reason. Munger continued by stating that there are bad tensions between the US and China and that these tensions persist because the US does not appear to understand that different forms of government are appropriate. China's system and policies were necessary for China even though they would not have worked in the US. Well, the Chinese government is causing much more concern among global capitalists than it previously did. We don't like that. We also wish relations between China and the US were better. And if you stop to consider it, consider how incredibly stupid it is that China and the United States allowed the current tensions to develop. What harm could result from our close relationship with China or the United States? Who the hell is going to bother us if we become good friends with the Chinese and vice versa? Along with Munger, many other prominent investors have kept up their China investments. Among them are Monish Pabrai, Sequoia Capital, Ray Dalio, and the titans of venture capital. According to Munger, the risk is reduced because the US and China will continue to maintain stable relations with reasonable honor. Munger's presentation gives us a context for his ideas. The markets are in a risky situation as a result of increased inflation. Fed tightening, supply chain problems, stretch valuations, and speculation. By allocating his funds to strong companies, Munger has modified his portfolio to survive these macroeconomic trends. 5 companies make up the majority of his portfolio: the US Bank, Bank of America, Wells Fargo, Alibaba, and the POSCO company from South Korea. These businesses have been selected by Munger as his long-term success stocks because he dislikes diversification. Let me know whether you agree with Munger down below. If you enjoyed this video, please hit the like button and subscribe. I'm Fred, and I'll see you in our next video here at Investing Wise Academy.